Good day. I'm Martin Gagel with Market Radius Research. It's Wednesday, March the 29th. We've got VP Investor Relations, Dmitry Kushnir, and CIO Kevin MacLean of STRR Royalties joining us. STRR Royalties is a carbon credit and precious metals royalty and streaming company. The company is here today to discuss how their model and their business works. And while the mineral streaming space is fairly mature, the carbon credit streaming is a new derivation on that. So I'm hoping to get a better understanding on both the mechanics and economics of the carbon credit markets and the associated streaming markets, and understand their assets that they have under management on both the precious metal side and on the carbon credit side. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the company. Gentlemen, thank you very much for joining us. And yeah, tell us about STRR Royalties.
Thank you, Martin, for the introduction. Kevin and I are pleased to be here. This is the first time that we're using this platform, and we hope this to be the first of many. And we look forward to give an overview of what STRR Royalty is and how it presents an attractive value proposition for our shareholders. So, as you mentioned, STRR Royalties originates royalties and provides exposure to investors in both precious metals and carbon credit spaces, namely especially within North America. I'll caution that there are some forward-looking statements within the presentation, and I'd like to kind of discuss what STRR Royalty is and how it came about to be. So we're a fairly young company. We've been founded in 2019 and IPO'd in 2021. So it's about 2 years almost exactly since we've been public. The origins of the company coming together was a team of capital markets and capital allocation and mining and portfolio management experts that have worked together in a variety of different capacities in the past, and they've decided to leverage those decades of experience to, especially with an alignment of philosophy on governance, disclosure, and transparency in both how to do business and how to communicate with stakeholder to create a royalty and streaming company within precious metals and carbon credits. While the original focus was on precious metals, there was always a green element to the business, where in the beginning, the idea was to do 80% precious metals and 20% green. But as the company has continued to develop and build and acquire and originate royalties, both in precious metals and carbon credits, we've received a significant positive feedback and interest from investors on the green side of the business. And so over these 2 years, there were over $48 million of US invested in 8 royalties and 1 stream. And that focus on green, that interest in green, resulted in us deciding to allocate capital and focus exclusively on a green side of the business by creating a GreenStar subsidiary in the end of 2021. Scroll forward a few months as the GreenStar portfolio has begun to sort of take place and generate critical mass. And about a year ago, GreenStar Royalties received an interest and became a joint venture with Agnico Eagle. Agnico Eagle, as I'm sure most of your viewers will know, is one of the largest gold producers in the world. It is an ESG leader in the mining space, and there was a significant amount of alignment in terms of how both companies look at geopolitical risk, about taking on risks that they're comfortable to take on, and sort of being a leader in quality within the space. So I will address the relationship with Agnico Eagle a little bit later, but as you can see on the slide here, there is we have a robust profile of revenue growth that shows here the STRR Royalties growth and the attributable GreenStar revenues as well. STRR Royalties remains a 62% owner of GreenStar, and because GreenStar represents the majority of the value proposition within STRR, since STRR is the only vehicle to participate in GreenStar's growth, I will spend a big chunk of this presentation on explaining what GreenStar Royalties is, and then I will zoom out and discuss how GreenStar fits in within the overall STRR profile and the STRR company.
Dmitry, so just going back to that estimated revenues, these are estimated revenues of STRR Royalties, sort of net, like when your pro rata share of the green STRR
Correct.
royalties?
Correct.
Okay.
These are 100% of STAR plus 62% of the proportional interest within Greenstar.
Gotcha. All right. And sorry, just the other portion of Greenstar that you don't own, you're probably going to get into this. Is that all owned by Agnico Eagle, or is that some other parties?
That's almost entirely owned by, the remainder is almost entirely owned by Agnico Eagle. So STAR owns 62%, Agnico owns 35%, which I'll mention later in detail. And then the remaining 3% are owned by management
Okay.
of the company. So since the bulk of the presentation will be about Greenstar, let's define what Greenstar actually is. Greenstar Royalties is a provider of capital for project owners that are ultimately going to generate carbon offset projects. So as you can see in the diagram, Greenstar provides capital up front in the form of provides upfront capital. The project developer then creates, the project is funded, originated, that ultimately results in generating carbon credits through the help of, in our case, a company called A New Climate, which is North America's largest carbon project developer. Once these carbon credits are issued by a respectable registry such as Verra, those credits are then monetized by A New, and then we participate in the revenue sharing agreement where we receive a portion of those revenues to our account. We have been very much innovating within the space. We're proud to say that Greenstar has innovated the world's first carbon credit royalty in both forestry and regenerative agriculture. And because of the royalty model, needless to say that it provides maximal operating margins to carbon credits to the shareholders. This element of innovation and effectively what we've done is we've brought over the royalty and streaming model that is very well understood and has a lot of experience from the mining and oil and gas sector into the green space. And that has been a very successful undertaking, because a lot of these carbon offset projects require that upstart capital in order to come into existence. And without this capital, none of these carbon within the projects that we fund, none of these carbon offsets would have been possible. So if we understand what Greenstar does, let's discuss how are we different from some of the other companies within the space, as there are several peers that we currently have. You will see throughout the presentation that what we are trying to accomplish is to be the quality leader within the space. This quality is really important, and it kind of permeates itself throughout all the aspects of differentiation. So first off is the geographical focus. You will note that our portfolio of projects is strictly within US and Canada, and our pipeline of projects is also strictly within US and Canada. While we will consider down the road areas such as Western Europe and Australia, the focus is on tier 1 jurisdictions. Now, why is that? There's a really good sort of battle scar earned reason for it. A lot of us come from the mining background, and as a result, we're hypersensitive to geopolitical risk, and we really try to undertake risks within the areas that we feel we can manage it. So that would be technical risk, that would be counterparty risk, but geopolitical risk is not a risk that we can manage. So as a result, we steer clear of it. So the second area of differentiation is our unique scalability potential. We have strategically chosen to have a flagship project in agriculture, specifically regenerative agriculture. That is an area that is both in high demand and sought after, but also has a tremendous scalability potential, in that in the US alone, there's about 1 billion acres of farmland, of which 400 million acres is specifically row crops, which is the area where we operate. And the scope of our regenerative agriculture program currently is to cover 1.32 million acres of US cropland. At full scope, that would represent only 0.3% of the US cropland alone, not even mentioning Canada, which is a significant powerhouse in agriculture as well. Furthermore, as another little stat, from nature-based solution, the mitigation potential that agriculture represents is 43%. So that means that from all nature-based solutions that can generate mitigation potential in carbon credits, agriculture will represent 43% of that. So we're in a good area that has a very high scalability potential. And over the past year and a half or so, as we've been conducting a lot of business development initiatives and building our network within the space, we've been able to accumulate now a strong advanced stage pipeline that is currently represents about $200 million over 22 investment opportunities. Now this number is actually a little bit stale. In the last several weeks, we've had multiple meetings at carbon conferences, and I think that number is a little higher now. But what this means is that we're in fourth, fifth, sixth discussions with project owners and in advanced stages of due diligence. And as we bolster up our own purchasing power over the near term, we will be able to allocate some of that purchasing power into the highest return, highest quality projects within this project pipeline.
Sorry, when you talk about project pipeline, that is a potential for you to invest $200 million in green projects that would reduce carbon emissions. So that would kind of require $200 million of investment from you to fill that entire pipeline. But you're high grading it, trying to prioritize which are the best ones.
Absolutely, absolutely. So far, we've deployed about 1/7 of it to now. So to have this type of a sizable pipeline to choose from will give us really the flexibility and the optionality to focus on the best quality projects. Again, all within North America. That focus I already talked about geographical focus, but there's a real, from a sort of conservative nature of the management team. I think we all subscribe into the Warren Buffett philosophy of invest in what you know. And for me personally, that meaning that you understand that you can, take a flight, take a drive, see the project. Our CEO, Alex Pernin, and myself have been out to site on multiple farms last year. We met the farmers. We understand kind of both the personality and the philosophy of how these projects are being developed. So as we focus on quality, and again, that's a recurring theme here, what we're trying to accomplish, the way we're sort of ensuring quality is by taking every component of the business model and partnering up with the best-in-class or world-class partners. As we talk about carbon project development, the company that we've decided to partner with to date has been A New Climate, formerly called Blue Source, and it is North America's largest carbon offset developer and marketer. And that is really important because A New has over 400 carbon projects developed under their belt of experience. They are the largest developer and they're the largest marketer of these credits. If you recall, I mentioned that we are focusing on the types of risks and core skills that we're comfortable with. And so marketing offsets is not our core, not our core skill. As a result, A New will be marketing our offsets. And because of the revenue sharing agreements, we are ensured that there's an alignment in the incentives to generate the highest possible price for these carbon offsets. Moving on from the project development side into capital partner, again, we've been fortunate to partner up with Agnico Eagle Mines. It happens to be my former employer. I spent 12 years at Agnico Eagle in business strategy and investor relations, and they are an ESG leader within the gold mining sector. There is a lot of alignment in how the companies think about geopolitical risk, quality leadership, focusing on ESG, and also a people-first culture. The word alignment is cannot be overstressed enough. We're really focused on alignment with counterparties, and I've mentioned on that here with carbon project developer and capital partner, and I'll also get onto that when we discuss our alignment with the farmers themselves as we create carbon programs with the farmers. And finally, last but not least, we're fortunate to have a tenured team of experts with significant experience in a number of fields, including carbon technical expertise, capital allocation, portfolio management, and as well as mining as it comes to the precious metal side on the STAR side of the business. Any questions so far?
No, I actually have a lot of questions, but I'm sort of forming them, and I'll get to them in a bit. I think it's a good introduction, so no need for me to interrupt here.
Sounds good. So as we're creating or investing in projects that will generate carbon credits, and this focus on quality The carbon credit space is a little bit like diamonds, that not all diamonds are created the same. Well, not all carbon credits are created the same. If you look at the market price for carbon credits on any, whether it's Bloomberg or any other marketplace, there are some carbon credits that sell for $2 a ton, and then there's some carbon credits that can sell as high as $200 a ton. So there's a significant difference in quality. And by us focusing on highly sought after, in demand, premium voluntary carbon credits, what does that mean? Well, that means that the credits have to have specific attributes that are non-negotiable. They have to be real, which means that they're supported by science-based evidence, that the emissions are actually removed or avoided. They need to be verified by a third party, again, aligned with strict registry standards. They need to be measurable. That's fairly obvious. There's a permanence element to them as well, which means that there needs to be no or low likelihood of any benefit reversal. And we can talk about that later. But basically, there needs to be a confidence that once this carbon is removed or avoided, that's a permanent effect. And they have to be additional. The additionality element is one that is really important to go over, because additionality means that some new net benefit needs to happen that did not exist before. So as an example, if there's a conserved forest, if there was a forest that was conserved for whatever reason for the last 100 years, then and no trees were cut, it's not possible for that forest owner to say, well, why don't I generate carbon credit revenue from this? Because there's no additionality. This forest would have never been eligible for logging, or would have never, it was always conserved. So therefore, that in that situation, there would be nothing additional to it. So the additionality element is a big criteria that the registries check for every single carbon project assessed.
On that point, because that with the additionality thing, if it was on private land and then some guy was planning on cutting down the forest at some point and then says, oh, now they're carbon credits, now I'm going to maybe reserve it so it's not allowed to be cut down in the future, could you then kind of claim the credits for that, or is that where a whole lot of nuance? We could have a very long conversation about that.
We could have a long conversation on that, but the short answer is it's not as simple as he said or she said. There needs to be a track record demonstrated that on that private land that there has already been a track record of logging operations or monetizing for timber. And so if they can demonstrate that, then all of a sudden they can say, we're going to preserve this land and stop it, then the additionality concern is addressed.
Okay.
The not double counting, that kind of goes without saying, but nonetheless, it's important to make sure that through the various supply chains, the carbon credits are not double counted. For example, to give a tangible example there, if a farmer generates carbon credits on his land by either regenerative agriculture or forestry or whatnot, and they claim the carbon credits, well, those carbon credits cannot be then claimed again if this feedstock or if the material is used for biofuel for an airline or something like that. So there can only be a single time of where the carbon credits are being counted. In addition to all that, there's typically co-benefits based on the United Nations Sustainable Development Goals, and those can be environmental benefits, biodiversity, and social benefits to the various operations where the projects are based in. And again, the geography, we believe, is a big factor in determining premium credit pricing, and we're trying to focus on those lower risk jurisdictions.
So Dmitry, on that co-benefits, I guess the opposite would be, my kids were giving me a hard time about that. Carbon credits, there's a lot of nonsense going on there. They're saying this over the dinner table, where maybe you plant, I think they were saying planting eucalyptus trees in South America because they're not native there. You get the carbon credits, but it kind of screws up the biodiversity, or it's a monoculture. Are the there's so many dimensions as to what is sort of good for the earth and for us. And you mentioned premium carbon credits. Are those, like, if you reduce carbon, but then you make a stream really dirty, let's say, are those offsets somehow incorporated into the quality of a carbon credit?
I think that usually when the carbon project is being assessed, there's There's a project description that's being provided to the registry in order to assess the sort of the holistic benefit of both carbon credit potential as well as the sustainable development goals. And I know a lot of the questions relating to that are also about what is the impact on the biodiversity, what is the impact on water, what is the impact on nitrogen emissions and things like that. So it's a comprehensive approach.
All right.
So having discussed kind of why we're focusing on premium carbon credits, you'll notice that, where are we? So Green Star, you'll see the map is not of the world. The map is of North America for the reasons that I've already mentioned. Currently, we have 4 assets within the portfolio. The flagship remains regenerative agriculture with Anu as the carbon project developer. And we also have 2 improved forest management projects, both in Canada. One is in Ontario, one is in Alberta. Both of those are gearing to be used in the compliance markets. So your viewers in Canada will know that we have a carbon tax within Canada that is currently, well, actually in 2 days will become $65 per ton or per credit, and is expected to grow to $170 per credit by 2030. So both of those projects are aiming to be generating credits that will be applicable under the compliance market. The regenerative agriculture is voluntary at the moment. And then we also have an investment in a company called MobiSmart, which is a provider of trailerized off-grid diesel displacement power solutions. We're looking forward to see how that project develops because one of their end users is to provide, as I mentioned, off-grid power solutions to the U.S. telecom space. And ironically, MobiSmart will be or is the first cash flowing royalty within our portfolio, while the regenerative agriculture, our flagship program, is expected to begin accruing carbon credits at the end of this year, and then having them coming into our account in 2024, as the graphs show on the right-hand side. As Green Star comes towards its full potential here, it will be generating about 600,000 credits per year. And I want to mention something that is really key because we take it for granted, but in a lot of our in some of the meetings, perhaps it's not as obvious as it is. This trajectory of both revenues and carbon credits, it does not rely on new projects. There's no growth built assumed in there. This is just the existing portfolio of projects coming into their steady state sort of run rate. Because often you'll see companies that show these hockey stick profiles, but it assumes a new pipeline of projects coming in at whatever 30-40% rate. In our case, it's not the same. This existing portfolio of projects that we have has this profile of both revenues and carbon credits.
On the revenue side, those are selling carbon credits in 2026 or 2027, correct? So correct. There are some assumptions there on the price of carbon at that point, or they're like forward sales that you can kind of offset or hedge the carbon credit value today.
That's a great question, Martin, and that could be an entire half-an-hour conversation on its own. But it's definitely the right place to discuss this. So with this focus on quality, conservatism is a big aspect of it, and so keeping in mind that each of the projects are so the regenerative agriculture is in the voluntary space. We're modeling for 2024 at $21 a credit. Just for context of what that means, the first year's worth of full production, about 500,000 credits, have already been pre-sold by our carbon developer partner Anu at about $20 a ton. So the $21 assumption is quite conservative, considering that would happen in 2024. And then also by comparison, some of our peers within this regenerative agriculture space are presently selling their credits for $40+ a ton. So the $20 per ton that we're assuming, or the $21 a ton, is extremely conservative.
But is that the current spot market for carbon credits, or is that what the $40 a carbon credit, is that like a future on a forward contract?
So the current spot market, or the most recent transactions that are particular to this type of credit, we've seen $27 a ton. So this the current the $20 pre-sale has been just to lock in that first year. Yeah. To answer your question as to whether the expectation is to continue to hedge these offtakes down the road extensively or not? The answer is no. I think the answer is very much within reason, because we have revenue sharing agreements with Anu, and so both of us are very much incentivized believers in the upward trajectory of carbon credit prices from this space in general. So we would not be taking any kind of significant pre-sales down the road. In this case, it was only for effectively 1 year's worth of production, and I expect it to continue to be very manageable in scale. And then I think, in terms of the other projects, so the compliance projects have been modeled simply at the Canadian carbon, at the Canadian compliance carbon market pricing, with $65 per credit for this year, and then a $15 per credit increase every year until 2030. And so what I'll do is, since as you can see, the vast majority of the value within GreenStar comes from regenerative agriculture, then we can do a little bit of a dive in of what that means and how it works. So what is regenerative agriculture? Well, regenerative agriculture refers to adoption of sustainable farming practices by farmers. And what does that mean? That means either not tilling or reducing the tillage of the land by the farmers, managing the use of nitrogen, phosphorus, and potassium fertilizers, so NPK fertilizers, and reducing their sort of the scale of their use, as well as using cover crops and a number of other practices, including, in our case, on top of everything that I just mentioned, the use of probiotic fertilizers. So what our regenerative agriculture program does is it funds the use by American farmers of probiotic fertilizers that then improve the efficiency of the nutrients exchange within the soil. As that exchange is enhanced, it increases biomass and improves the rates of photosynthesis, and then that ultimately results in higher yield. And in addition to that, it also results in sequestration of carbon, organic carbon, into the ground. And so you can see on the right-hand side of the slide here, the sort of before and after by comparison of having, a grower that does not use the probiotic fertilizers, and then the grower that does, and you can see the difference in the biomass within the root structure. As you can imagine, agriculture being quite a low-margin business, any type of yield increase goes directly to the top line, which then has a multiplier effect to their net margin per acre, and that increase can be quite significant. We've seen from the field studies that there's an average, within for corn and other row crops, if the average margin that the farmer expects to generate per acre is $25, the yield alone, the increase in the yield alone can boost that by about $40 per acre. So it's a very significant potential for the farmer to increase yield. And
sorry, so 1 year a farmer will make $25, and in this prototypical example, on growing corn or whatever crop, but they could actually make $40 on the growing carbon, essentially, or locking in carbon in the ground.
No, what I'm saying is, well, it's not because of the carbon, the yield increase. So as a result of using the probiotic fertilizers, the increase of the yield by weight or by quantity will result in an additional margin that will equate to $40 an acre. And then that 25 is variable. That it's averaged out, but you could have a drought year, you could have a high cost of fertilizer year, so that's pretty variable. But from what we're told by the farmers, the average yield per acre is about $25.
And then on top of that, would they benefit as well from the carbon credits on that?
That's a very good question, and it's one that I was just going to mention. So within our program, we as GreenStar, we're not as focused on the yield. I think it's a fantastic benefit to the farmer, but for us, what we're concerned about is the amount of carbon that's being sequestered into the ground. So as that carbon is sequestered, measurement and verification is done at the beginning of the planting season and then at the end of the planting season. And then as the measurement assesses the amount of carbon contained per acre, every ton results in the carbon credits. And so over time, that carbon concentration within the soil increases, generating the ability to generate carbon credits for us. So I mentioned alignment, and this is that point number 3. The alignment is very important because within this program, the farmers actually benefit three ways. One is the yield increase, which I just described. The second one is they also participate in a portion of the revenues from monetized credit. So that means that there's a price participation. So as the carbon credit price goes from $20 to $30 to $40 or whatever the price may be, they'll participate in sharing a portion of the revenues from the monetized credit. So that's the second source of revenue. And the third source of revenue would be from sort of the equivalent in the mining space as throughput. And what I mean by that is there are the models that underpin the calculations of carbon sequestration assume a certain rate of carbon. If the farmers being particularly diligent at using all of the sustainable farming practices, and if their soil generates more carbon or sequesters more carbon than we initially modeled, they will also benefit not only from the price of the carbon credit, but also from the amount of carbon credits generated. So there's price, there's volume, and then there's yield itself. So that creates a very aligned structure between us and the farmers.
Okay, so I guess conversely on that, what if, I don't know, they do something wrong or the estimates are wrong and they actually produce fewer carbon credits than they were expecting? Is there a sort of like a clawback, or you just don't get to recognize them that much that year? Or?
It's a great question, Martin, and a really important one. So I think, the events or the circumstances where there could be a lower than expected carbon content in the soil would typically have, maybe there's a drought one year, or maybe there's a fire of some sort. So as a result, to compensate for that, the programs have a buffer that is about 30% of the total credits generated. And a buffer is geared specifically for, the term is called reversals, where there's any kind of a one-time discrepancy between what the amount of carbon that was assumed to be sequestered in the soil between what it actually happens. Those potential reversals may happen on a farm or in several farms, but as we spread the scope of the program from, this kind of brings me to the bottom of the slide here, as the scope is expanded to 1.3 million acres, the amount of farms that, not only is it unlikely that this reversal is going to happen, but also if that reversal does happen, it would be impacting an increasingly smaller portion of the entire program. So that's covered by that 30% buffer pool of credits.
So standard sort of portfolio theory, you've got a bigger portfolio of acreage, you get some variability across it, but overall it should be less volatile.
Correct. And in addition to that, Martin, over time, the health of the soil, which has been degraded for 100, 150 years by using all of these NPK fertilizers, the health of the soil is being restored through the use of the probiotic fertilizers. And as they proceed to go further and further into the program, the healthier the soil, the more carbon sequestration there is. And so as we model things, our expectation is, I think we've modeled something like 1 ton per acre, but the actual, the ultimate goal is to have sort of 2, 2.5, and possibly 3 tons of carbon per acre delta. So over time, the sequestration of carbon is expected to increase as well.
Gotcha. And sorry, when you invest money in one of these projects, you're investing hard dollars. Is those dollars being spent on the fertilizer, or how does the capital get allocated? Good
question. So in our specific program, we are funding the farmer's use of the fertilizer, because if they're generating, and in particular, we're paying them $12 an acre upfront, and then for on an ongoing basis, the program will pay. The revenues from the program will continue to fund that. So our own contribution is necessary to kickstart or to really originate this project into coming into existence. As you can imagine, if we use that $25 per acre margin, then a $12 per acre payment is actually a significant component of that on an annual basis. So the farmers, while being interested in participating in this, wouldn't necessarily have the capital to undergo through this carbon program, but that's where our capital is useful. And in fact, we provide a bridge by our program to between kind of going back to an earlier slide. What we're doing by this is we're originating a stream of carbon offsets that then can be used for sale for multiple companies' corporate net zero goals down the road. So yeah.
So with like going back to the mining model, as a royalty company, you give them a bunch of money that's non-dilutive or non-interest bearing capital to help build it out. And you get a percentage of the gold or the carbon that comes out of that. If whatever if something went wrong and it produces less gold or less carbon than expected, your revenues would then be lower, and the farmer wouldn't have, let's say, liabilities like a bank saying, hey, you got to pay back. They've given up a portion of their carbon credits that they're giving up. So they haven't taken on a liability, but sort of an obligation to share the carbon credits, right?
That's right. So that risk is borne by us as funders of the, as part of the revenue sharing agreement. If the farmer generates less than expected amount of carbon and therefore carbon credits, then the amount of credits monetized is being less, and therefore then our portion of those revenues is less as well. So it's not, but the farmer will benefit from yield definitively, and then the success of the carbon sequestration model lies on us, as we're literally funding and being partners with the farmer in this project. I want to talk about scalability a little bit. Our initial size of the regenerative agriculture program was 320,000 acres, and we've been overwhelmed by the positive response from farmers, and very quickly realized that it's not enough, that we need to increase that scope. So we've quadrupled the program to 1.32 million acres. Now it spans over 15 states and 115 farmers across the United States. And we're very encouraged by the enrollment results and kind of how the program's going on. And we're looking forward to be able to increase it again over the next year and a half or two. The partnership with Anu is an important aspect, because as they are the carbon project developer and marketer of credits, we expect this to result in future regen ag projects of larger scale down the road as well. And so just for further clarity in terms of how the flow of funds work. So it's a relatively straightforward model. You can see the green star here is at the top left. We provide upfront cash payments for a 10-year period. And then those 10-year periods can be extended down the road. Our agreement is with Anu. Anu then uses these funds to subsidize or to fund the farmers' use of the probiotic fertilizers that are being manufactured by Locus Ag. Once Anu prepares these uses third parties to verify and measure the carbon assessment, and then sort of pushes the project all the way through towards the registry to assess that the carbon's been sequestered and that carbon credits are issued. They're then monetized, and we participate in the we participate in the revenue sharing agreement with the part of the proceeds from the credits. So moving on to the partnership with Agnico as a capital partner, because I think it's pretty obvious how important that the carbon project development partnership is with Anu. On the capital side, Agnico has demonstrated interest in this model, as they are one of over 8,500 companies that have stated a goal to be net zero by 2050. And the challenge with that is that while it's nice to be able to say we're going to be net zero by 2050, there needs to be a path towards getting there. So companies can actually allocate budget for it, but there needs to be avenues to deploy this budget. And so Agnico's strategic investment into Greenstar was a way to create that path towards their own net zero commitments. And they can co-invest with us up to a certain amount with projects, and they can also buy our offsets at fair market value to be able to use towards against their own emissions profile.
So not to speak, I presume Agnico Eagle is partnered in this. They're doing this. They're not going to sell the credits. They're going to use it to offset their carbon emissions, so they can get towards what I'm guessing is at some point a zero, a net neutral carbon emissions profile. That
would be a very reasonable assumption, since they're not in the business of speculating on carbon credits. I think that the majority, if not all, of the carbon credits that they would take will be specifically to mitigate their own emissions footprint.
Gotcha. And on the structure of Green Star, are all the investments like off of your balance sheet, or is it work like a general partner, limited partnership, kind of like a VC private equity model where you're investing other people's capital, or does all the investments into the green projects come off of Green Star's balance sheet?
So all of the investments are on, because Green Star is a separate entity that operates as a private joint venture that is owned, according to this pie chart, 62% by Star and 35% by Agnico. So all of the investments are on Green Star's financial statements, and then ultimately, as Green Star continues to get critical mass and at some point down the road becomes its own standalone private or public entity, all of those projects will continue to remain on Green Star's balance sheet.
All right. So if you need to, if Green Star needs to raise more capital, issue more equity, or I guess take debt on to then use that to fund the different projects, or the profits, the operating capital generated, then reinvest that in the business.
Sorry, say that one more time, Martin, please.
Let's say if you wanted to double the size of your investments, you could I get new equity, you could borrow money, or you could just wait for your operating profits to sort of fill the coffers so you can redeploy it.
It's the first and the third. It's not the second. So we could wait until the coffers are refilled, but I think the preferred method is to actually go through an equity approach.
Yeah. Have you guys contemplated being more of an asset manager, like where you act as a general partner, you take an LP of funds and you manage it and take for a 10% commission or whatever off of that, and sort of be able to expand your business without adding to the balance sheet directly?
We have had some of these discussions internally, but I think I'll pass it over to Kevin to answer that one. Kevin, you're on mute.
Martin, we've been offered that sort of opportunity and we've turned it down. We think it's more important at this point to establish our critical mass as a self-sustaining, quickly growing first mover in the space. And then we'll look at growth opportunities from there. But I personally doubt that managing assets for others is the best way to go for us.
All right.
Okay. So with Agnico as a partner and having bolstered our actual carbon expertise by adding two phenomenal carbon experts in our chief commercial officer and chief development officer, which I'll talk about shortly. We've been able to build now, as I mentioned earlier, a robust pipeline of $200 million of investments that are spread among 22 projects. The projects that we're considering are all within the nature-based solution space. About a third of them are in agriculture, a third of them are in forestry, and a third of them are in others, including biochar that we're looking at the moment. Purely for illustrative purposes, on the right-hand side, you can see that our current portfolio of projects would be generating undiscounted cash flow over the life of the project of just under $300 million. Were we to execute on the entire pipeline, that cash flow undiscounted would be north of $1 billion Canadian. So there's a significant potential to deploy capital, and we prefer to be in that state of having tangible users of funds. So as we consider increasing our own purchasing power, then there's an immediate and tangible opportunities to deploy that capital effectively.
All right.
And so then, as a recap, before I zoom out and kind of go to how it all fits in within STAR, Green Star is being built and has already been built as a quality leader in carbon financing for a number of reasons. Namely the geographical focus on not only nature-based solutions, but also ones that are located in preferred geopolitical jurisdictions within North America. It has an immense scalability potential, especially from the regenerative agriculture side. There's already a robust pipeline of projects for future growth opportunities. And we've, again, going back to that quality element, we've partnered ourselves not only with one, but two world-class partners in carbon development and in capital, being a New Climate and Agnico Eagle. And we're run by a really great team of experts that have both carbon technical, capital allocation, and portfolio management expertise. And so, having said that, how does this fit within the parent company being STAR Royalties? Well, as we look at the map now of STAR royalties, you can see that there's still a heavy concentration on North America. And we have a cash flowing asset that has actually been a real outperformer in Western Australia. That is a titanium sand project that we bought, I believe, a couple of years ago. That project has been outperforming our expectations. It's called Keysbrook. We also have a couple of other precious metals projects of note. One being a open pit deposit in British Columbia called Elk Gold. That project is also cash flowing. Came into production early last year. It has experienced a little bit of some teething pain, but having been in the mining industry for let's say 12 to 15 years, I think that almost every project in the mining space, as they start up, there's some teething pains. And we're very pleased to see that in the past 6 months, there's been increases in both grade and throughput, and we're continuing to see to look forward to 2023 to continue that improvement in operating performance at Gold Mountain, who is the company running Elk Gold. The Copperstone project that we have is an underground project in Arizona. It's nearing towards production, and again, we're pleased to see that the management of Copperstone has taken steps to simplify the capital structure and create an environment where the Copperstone asset can move forward towards production sort of in the next 12 months or so. Overall, how does this look like? There's a lot of information here, obviously. From I guess what I'll say is that on the top right there, when we look at our NAV, the green side of the business makes up 70% of the NAV. This is the STAR attributable 62% base of the NAV is 70%. And that is currently where the management team is allocating a lot of its time, majority of its time, as we wait for the precious metals asset to kind of come into their own right and into their own sort of steady state potential. From a capital structure standpoint, there's a tremendous opportunity here. We believe there's a really strong valuation disconnect, and the valuation disconnect is very simple. There's a couple of ways I could describe it, but it's very simple. STAR owns 25 million shares of Greenstar. Last year, when Agnico invested into Greenstar, they paid $1 a share. And that was prior to us quadrupling effectively the entire Greenstar portfolio because we quadrupled the regenerative agriculture program. So if you were to effectively, whatever that multiplier effect is, whether it's $4 or $3 or $2, doesn't really matter. Our market cap right now is just shy of $30 million, which means that what an investment in STAR right now would accomplish is a deep discount to the Greenstar value and the precious metals business for free. So what that means is that as management team, we're very much excited to advance through 2023 and help our catalysts realize that value and bridge that and eliminate that valuation disconnect. I'll also mention that we're one of the few companies that, or if not the only company, that shows this waterfall graph of how shares were issued and at what prices. And I can say that the management's average purchase price of STAR shares is between 40 to 50 cents. So by buying shares right now at 38 cents, new investors would be coming in at a price lower than management, thereby highlighting the really strong alignment between management and shareholders as we continue to move forward. Speaking of management, so we have a very experienced team of capital allocators and carbon experts. I can really highlight any one of the team, but Alex Burnett, our CEO, used to run capital allocation program for Barrick Gold. Barrick Gold needs no introduction. Tony Lesiak, our chairman, has been a ranked analyst on the streets within the mining space and really familiar with royalty and streaming space. Kevin, who's on our line, who's on the call with us, obviously has been an award-winning portfolio manager working for a company called Sentry, and he managed a portfolio at one point over $2 billion under management. Tanushree is our chief development officer. We've been able to attract her from one of the largest registries in the carbon space called Vera. We're very fortunate to have her and Rina Serrato, who is also a greenhouse gas expert and advisor to the International Emissions Trading Association. So between the two of them, they give us that ability to do due diligence on the technical risk. I mentioned earlier that we're choosing to take, we're focusing on the risk that we're comfortable dealing with. So that means that with their expertise, we're able to assess the technical risk of a carbon project, and we're able to understand what's the probability of default. And ultimately, as a royalty company, when we think about the biggest risk profile for us, or the biggest key risk area, it's in counterparty risk management. Because of the royalty structure, one of the most important things we need to do as we do our own due diligence is to assess, is this a credible, worthy counterparty? And we accomplish that through our own technical expertise and also leveraging a new Climate's 400 plus project experience under their belt. And then finally, last but not least, Ken No is our CFO. He came over to us from Franco-Nevada, who is the world's largest royalty and streaming company. So he's familiar with the financing aspects of royalty and streaming structures. I came most recently from Agnico Eagle, where I spent 12 years. And again, I think that there's a strong alignment between our MO and philosophy of how to conduct business and our capital partner. We're also fortunate to have a really strong and experienced board of directors from whose executive experience comes from a variety of capital markets and mining companies. And we like to think that this is a board that the company needs to grow into, given kind of the quality of the caliber of the members on the board. So to sum this up, where does this leave us? We are a very differentiated royalties investment proposition. On the STAR side, there's tremendous value to be realized by the precious metals portfolio coming into its own value realization, as both Gold Mountain continues to improve their operating performance this year, and as Copperstone inches towards or approaches production over the coming 12 months or so. On the Green Star side, we are continuing to expand the flagship regenerative agriculture program. Our capital partnership with Agnico allows us to consider and to give us access to larger projects. We're continuing to stay within North America, and we look forward to over the coming months to add to that purchasing power so that we can execute on the robust portfolio or pipeline of projects. And that's sort of the presentation. I'm happy to open this up for questions.
That was great. Oh, wow, that was a lot of information there. I guess I think one quick question on Green Star, and then I want to switch over more to the traditional precious metals streaming side. When you look at like your project due diligence, you're dealing with, or Anu is dealing with, lots of different farmers. Do they kind of pool it up into like one kind of a pool of assets, and then say, hey, do you like an LP sort of structure, and then say, hey, do you want to invest in this one, or this is how we're designing this LP to invest in? Or is it individually do you pick and choose which farmers you work with?
So it is on it's yes and no is the short answer. So the program does act like an aggregator in the sense, in fact, regenerative agriculture is almost an asset class in itself because of the aggregation of multiple farmers. But at the end of the day, though, each of the farmers has an agreement with Anu separately, and because each of the farmers has to be accepted into the program. And in fact, the name of the program is called Carbon Now. That's the trademark name. And what makes it unique, in addition to the use of, or maybe because of the use of the probiotic fertilizer as a soil amendment practice, is that it welcomes farmers that have been already practicing a lot of the other sustainable farming practices for a period of time. And I mentioned additionality. So if you have a sort of forward-looking progressive farmer who has been using this no-till practices or any of the other practices that I mentioned earlier for, let's say, 10 years, if he then wants to, or she wants to take advantage of carbon credit revenue, well, they'll be denied by a lot of the other carbon programs because there's no additionality. They've already been doing it. But the use of the probiotic fertilizer adds a new element that helps sequester more carbon into the soil, and thereby sort of we welcome them with open arms. And that's been sort of a big attractive feature of it. And but each of the farmers have their own agreement with Anu, and they have an agreement with Locus Ag for the fertilizer, and that's how it's structured.
All right. And I guess the following is more for Kevin here on the traditional precious metal side. There's a question here from the audience. I'm interested in learning more about plans for the precious metal side of the business after Greenstar. And they say after Greenstar is taken public. So I guess going back to Greenstar, is the future for Greenstar potentially to go public or sort of stay as this joint venture between you and Agnico Eagle?
Yes, so excellent question, and we talk about this internally quite a bit. The intention here is to get Greenstar public as quickly as possible. We want to lower our equity cost of capital by having that public low risk trading vehicle that people can access more quickly and mark the market every day. We have the ability to do that, we think, within 12 months, simply by raising some private capital and perhaps doing a public offering. Secondarily, we could also have the private company acquire the public vehicle, STAR Royalties, and become public much faster. In order to do that in a sensible manner, since green investors typically don't care for mining assets and mining investors don't necessarily understand or care for the green part of the portfolio, it makes sense that you might want to consider divesting the precious metals mining assets. Fortunately, we've been approached a number of times from potential acquirers of our portfolio on the mining side. I'm not against doing that, but it's not the right time. 4 of our 5 investments are doing as or better than we expected. The 5th one, Copperstone, is behind schedule, and we're helping management to get them back on track with that. So at the right time, I think that could happen, by the way, the next 12 months. It might make sense to consider just monetizing the mining assets. And if you look at it pragmatically, our CEO, Alex, is spending 120% of his time on the green side of the business now. I'm carrying the precious metal side, but the precious metal side is on pause, effectively. We're not allocating additional capital to precious metals while we're maxing our green portfolio. So I think there could be some very interesting things happen. I'm very focused, my portfolio manager hat, at maximizing the value of STRR Royalties, minimizing our equity cost of capital, both for the parent company and for the private co that we have within us. And so the ways to do that are to arrange the portfolio pieces in the most optimal way. And I think that's along the lines of what I just discussed.
All right. Okay. So there's not going to be new capital invested on the precious metal side. Focus going forward is sort of unlocking value by presumably separating the assets so they get there's no so they're just clear assets to be valued by the market, and exactly how Greenstar gets separated from the mining assets is there are a lot of smart people with experience in this space sort of figuring it out the best way. That's
correct.
All right.
And Martin, just to add one little thing there is the reason for this significant focus on the Greenstar is because we've determined strategically that the best and the fastest way to realize shareholder value is to unlock the value that's built in within Greenstar, and that's where we're focusing.
Gotcha. And if you're able to realize that through cash, then you can right away redeploy that cash into the Greenstar side and have that as investable assets for you guys.
Exactly.
Right. Yeah. Okay. We're a little over an hour here, so we'll probably start wrapping it up. I guess 2 things, sort of final concluding comments, and then you've given some indication in the next year. I guess we'll hopefully be getting some news and better indications from you on what's going to happen with STAR and Greenstar. What other sorts of news flow should we be looking for, maybe in a little bit of the near term in the next quarter or 2 with I don't know, new developments?
Well, I think that we continue to explore funding opportunities on the Greenstar side, and then as those materialize, we'll be able to deploy them within the pipeline of opportunities. So I think that's a big realizer of value, or that's a big catalyst for value realization. And both Elk Gold and Copperstone, we're expecting to have some meaningful catalysts over the course of the year as they progress towards their, in one case, steady state production profile, and in another case towards production period. But I think much of the catalyst value is gonna continue to be on the Greenstar royalty side.
All right, gentlemen. Kevin, any last?
Yeah,
to say something.
I just I just wanted to add, Martin, that interestingly, the most knowledgeable investors and potential suppliers of capital to Green Star are not the conventional investment management funds or hedge funds, even the private equity groups. It's actually corporations that are actively engaged in mitigating their carbon footprint, and they've developed their own internal sustainability teams and carbon expertise, and they're knocking on our door all the time. So we're quite engaged with them, and it's actually quite a pleasure to be engaged with them because they're adding to our knowledge, and they're very serious denizens of this space. They know the space, they know what they want to do, and that could be out of left field perhaps to some, but it could be another source of capital for Green Star.
All right. Okay, gentlemen. Well, on that, let's wrap it up here. Thank you very much. I really enjoyed that. Learned a lot. Fascinating business model and this whole new economy of carbon credits we're coming into. So I really appreciate spending the time here. Thank you very much. And I definitely would love to have you come back as your business evolves and news comes out on the progress of STAR and Green Star.
Thank you, Martin. And as a reminder to your listeners, we're always available for comments. So if there's any questions, please feel free to reach out to us.
Thank you as well, Martin. Okay.
Have a great day. Talk
Bye.
soon. Cheers.